Welcome everybody to a live version of just going through my portfolio buys for the month of April. I want to do this for all the premium subscribers, both in the newsletter and on YouTube. So if you were watching this on a replay, I'll be doing this once a month, usually kind of early in the month. This way, just the way that the days worked out. This is a little over a week after those initial buys went out, but usually try to do that on Tuesday or Wednesday of the week that those buys go out. So that's kind of the idea there. If you are not familiar with the asymmetric portfolio and how it works, I started this portfolio from nothing. I'll just pull up these rules here that I kind of live by. Add $500 a month. So the idea here is I want to make this portfolio something that's accessible for everybody. If $50 is right for you, if $5,000 a month is right for you, if you're just looking at this as, hey, I'm here for the research and show me exactly what you're doing with your money. That's what the idea of this entire portfolio is. And I'm showing you how I'm building a big portfolio, building wealth over a long period of time. So invest $500 a month. The thing I added last year is if we do get to bear market territory, so the NASDAQ or the S&P 500 falls over 20%, haven't quite hit that point yet. But hopefully we get some nice pullbacks here in the next year or two, get some better buying opportunities. I'll actually increase that allocation. So that's putting my money where my mouth is and saying, hey, you want to be greedy when others are fearful. So that's the idea there, is to increase those allocations if the market falls. And I can buy any stock in the asymmetric universe, and any funds from sales or dividends is going to be reinvested over time. So we've got all the stocks in the portfolio. This is kind of the pool of stocks that I can pick from. Celsius I actually pulled out. So I updated that on the website, but forgot to do that before the email went out. So there are now 25 stocks in the asymmetric universe for the month of April. The idea here that I just kind of noted was there's a bunch of stocks that I like that are down significantly early in the year, but some of them are a pretty significant portion of the portfolio. So if you look at something like Hims and Hers and On Holding, I really like those stocks right now, but they are 8.3 and 8.7 or 7.2% of the portfolio at the time that I sent this out. So I wanted to stick to those stocks that were a little bit smaller percentage of the portfolio. And the idea with that is there's a quote that I really like that if you're right, a little is enough. And if you're wrong, a little is all you want. So some of these stocks, Hims and Hers, On Holding, I think there's reasons to be very, very bullish on both of those companies long term. But if I'm wrong, I don't want them to be 20, 30, 40% of the portfolio. I want to be able to acknowledge, hey, I'm not going to be right every single time. So I want to have maybe a little bit more allocation for some of those other companies that I may be right on. So I'm going to just go through these quickly and then I'll kind of dive into them a little bit more. If you have questions, get those into the chat. And then I also have the Google form that I sent out to all the newsletter subscribers pulled up. So if anything comes up there, I'll be able to see it. But $200 is Zillow. That was the first buy. I've done a few videos and articles about Zillow and just why I think this is a phenomenal business, aggregating demand in the housing market, multi-trillion-dollar market. I just think this should be far more than a $10 billion company. Long term, I think that'll play out. But short term hasn't been a great year for the stock. So I'll go through some of these things in detail. I'm going to actually start when I start going through these individually, start with Owlet. A lot has happened with Owlet, even in the past 8 days. So, try to put some context to that and what I'm thinking about the company. And then the third one is Garmin. Garmin really plays into, I think, the information about health is going to be really important in the future. So we had Whoop, which right before I sent this out, raised $575 million at a $10.1 billion valuation. Garmin's about a $42 billion company. Whoop is not providing a lot of value that Garmin can't already provide. And Garmin has many, many more devices out there right now, has a much higher price point, has more, they're actually selling the devices. So I think tremendous opportunity for Garmin. I'm going to actually pull this down for a second, pull up exactly what I had prepared for some of the Owlet discussion. I'll go through some of the comments that management had. And then the big thing that happened over the past week is going to be this news right here. Their CEO is transitioning, was the word. He actually put a statement out on LinkedIn. This one's been really the leadership at Outlet has been really confusing for me to try to judge. Kurt Workman is the founder, was the former CEO until 2023 of Outlet. I did not particularly think that Workman did a great job of operating a good company. There's a difference between being a visionary and being an operator of a company. We'll go through some of those numbers in just a little bit, but it was just burning through cash. He kept having to go back to the market and raise funds. That those funds typically came from their previous investors at kind of sweetheart deals. When I added this to the asymmetric portfolio, the idea was we should be headed in the right direction operationally, where they don't have to keep going back to the market. And so maybe those dilution days are behind us. That's what worries me about bringing Workman back in. Are we going to keep going on the financial improvement trajectory that the company's been on over the past couple of years, or are we going to go back to kind of this spending on all kinds of crazy things, just the lack of discipline that I think that they had when he was CEO before? Sometimes the second time around is a good thing. Take a step away from a company, see how things go. But we'll see. So I was a little bit disappointed by this. Was my initial reaction. The market actually had a pretty similar reaction. If I can pull up fiscal here, it was kind of a wild reaction yesterday. At this moment right here, the stock was down 17% for the day. So that's just crazy. But you can see that actually now the stock is up a percentage point or so since the announcement was made. So the market is not super worried about this. I keep going back to they've actually got plenty of cash on the balance sheet, net cash of about $10 million, still only a $136 million company. And their revenue, they're trading for about 1 times what you'd expect revenue to be in 2026. I'll go through some of those guidance numbers. But still, from an asymmetric opportunity standpoint, if this is a company that can compound their revenue 20+% over the next 5 to 10 years, this will be a phenomenal asymmetric stock. If they go back into, we're going back to negative free cash flow, we don't have traction with our products the way that we used to, then the company would be in a little bit more trouble. Well, let's go through. I'm going to go back to Q4 and just some of the comments that management made in this Q4 call that I think were really telling. And I put some of this in the buys that I had for the month, but and this is where if you got questions, just let me know, because this is one of the companies that I've kind of gone back and forth on. Stock performed extremely well. I think it was up 130%, something like that in 2025, and now it's really fallen back to earth. But have the operations really changed all that much? With the thing that was disappointing coming out of the fourth quarter, so into the first quarter and their guidance for the first quarter, I guess I can pull that up here as well. But they had a kind of a weak guidance. I didn't think it was all that terrible. Fourth quarter report. So we go down here to their outlook for the first quarter, $20 to $21 million, and a gross of revenue, gross margin of 50 to 52%. So that's implying some relatively weak growth. And then what they're expecting basically with this guidance, full year 2026, $126 to $130 million in revenue, which would be 19 to 23% growth. A lot of that would be in the second half of the year. Adjusted EBITDA maybe didn't increase quite as much as a lot of investors wanted, $3 to $5 million, representing 50 to 150% growth. So $2 million in adjusted EBITDA in 2025. Those numbers are solid, and the question is management kind of sandbagging these? So we look at operational international sell-through remains strong in the UK, up 58%. France is up 41%. Nordics countries were up 80%. So starting to get a bunch of traction in Europe. Then they're going to be adding secured regulatory clearance for Dream Sock sales in India. So there's another massive market. How big is India going to be for Outlet? We don't really know, but if it's even, 1, 2, 3, 4, 5% of babies that are born in India get an Outlet sock, that could be potentially a really big growth driver for them. So the layer of international growth they're planning to launch in the second half of 2026. They also talked about beginning distribution approval in Israel. So the international story is really starting to come together for Owlet. So the idea is, they had to go through this phase in the US where they had to get regulatory approval from the FDA to be able to market their device. That has kind of gone pretty well. You're starting to see some operational leverage there. You're starting to see uptake of their subscription product. I'll talk about that in just a second. But we're now starting to move international. So those are the things that we want to see. As it relates to guidance for 2026. Okay, so here's the other quote here for our full year 2026. We're expecting range of 126 to 130, representing 19 to 23% growth, like I mentioned. And then typical seasonality and subscription revenue is going to become a larger portion of revenue throughout 2026. So let's go through those subscription numbers, because I think this is where, if this continues to grow, this could be a phenomenal business. So not a lot of history here, but 4 quarters of history. You have 110,000 now paying subscribers for the Owlet 360 subscription. What they talked about on the conference call is they're going to be adding some services, some functionality in the future that could really add value to this. Let's see if I can find that quote here. The telehealth platform is really the big one that I think if you can integrate that in with the Owlet device, you get some sort of reading that is low oxygen level, for example, for your baby. Can I talk to somebody right now about that and do that on the Owlet platform? So that's the kind of thing they're talking about. So they want to drive adoption of the Dream Sock. Second, expand Owlet subscriptions. And then third, continue to grow through healthcare channels and the Owlet telehealth platform. So that's the growth optionality. And if we just look at what things have looked like for the company, where things are moving in the right direction. I'll do profit margin percentage because I think that's maybe a little bit more telling than operating profit. So I'll pull up trailing 12-month numbers. And again, you go back to when Workman was running a company in 2023. This was when kind of things were kind of their worst. So Jonathan Harris comes in and operations get a little bit better. I don't know what happened there. Clearly something happened that he's stepping away. Also, if you look at his history as an executive, he kind of comes and goes every 3 or 4 years. So is this the timetable that we should have expected that he was going to step away as CEO? I don't really know. There's obviously something going on there. And when we don't know the full story as investors, that's when I get a little bit worried. So it's on my radar. Like I said, this came out after I did my buys for the month. But what I want to see in 2026 is, can this revenue growth, put that revenue growth number in here to just kind of lay that over as well. So this revenue growth has been pretty solid. Is that going to continue improving? 35% revenue growth. Obviously, that's not quite where they were for guidance for 2026. But if they are able to beat their numbers, and let's say they grow 27% in 2026, that would be a really solid revenue growth number, especially if their margins continue to improve, which is something they need to do. They have cash on the balance sheet. I can just pull that in, take all these away quick. But they should have the cash on the balance sheet offsetting some of this short-term and long-term debt. Stack those together. $35.5 million worth of cash, a little less than $10 million worth of debt. So should be okay from a balance sheet standpoint if they get those operations to positive free cash flow. That's a lot of ifs. But again, this is one of the higher risk companies in the asymmetric portfolio. So let me know if you have any questions about all that. But I'm going to move on to Zillow. Zillow is a company that I've been talking about quite a bit over the past few months. They did a presentation recently that I thought was really helpful in understanding their business. And the framing there was artificial intelligence. I'll hide this for a second as I just kind of flip through here. But the framing was artificial intelligence is going to kind of be not a disruptor, but instead a benefit for the business. So the idea here, what I keep going over is Zillow is unique because they're an aggregator of demand, which would be this center part. So if you are a renter seeking housing, if you are a buyer or a seller of vehicles, this is going to be the place to go. Zillow is going to be the biggest place to go of all companies. Then on the professional side, so this would be the broker side on the right, and then the real estate owner, business owner. Sometimes it's a REIT, sometimes it's a small, family operation, but they've got single family homes all the way up to big apartment buildings. Both of these companies, Zillow is going to be a platform. So they're going to be what you're going to be building your business on top of. And that's what I think is ultimately the most unique. Most of their business is going to come from those companies spending money on the platform. So Zillow sees all of this information and then is going to be able to pull it all together using artificial intelligence. So they have the context, the content, and the integration. And these are the things that kind of separate them. If you look at what you could see or what you can see on, like, for example, in our area, Edina Realty is the big realty service. They just don't have this proprietary rich media because they're not a big enough company, even though it's one of those, Berkshire Hathaway owned brokerage companies. They just don't have the capacity to be able to build the technology platform to build all of these things. So this is like a AI slider. So you can, I believe it would be on the left would be the actual room, the way that it looks. And then on the right, you can click, these are different styles that I want the room to look like, and it'll kind of AI stage it for you. So you can kind of visualize what things look like. So really interesting, really valuable. And then on the right, if you haven't looked at, if you haven't seen these, go check out Zillow. They build out this whole floor plan. This is just with an iPhone, a broker, a real estate agent. Even a normal person can just go around and film your home with your camera, and then it's going to build out these tours and actually show you what the images look like. So this is way better than, we bought our house in 2018, and you're trying to look through images and go like, okay, how big is this room? Is this picture being taken, right up against the wall? Is there a few feet behind you? It's just really hard to get a feel for the size of a house until you actually get into it. Something like this really helps visualize those things. So that's what they're calling rich proprietary media. And this is going to be making its way to apartment buildings, but it's got homes right now and then also new construction. So they've got all that content. And then the big thing is, this is on the real estate buying and selling side, is these are all the products that real estate agents are going to be paying for and using. So you have Follow Up Boss, Showing Time, which is going to be the scheduling app. Apparently 90% of in-person tours are scheduled with Showing Time. Just a absolutely crazy stat. So you can actually just use Showing Time. You don't have to use Showing Time and Zillow. But so that's a foot in the door with a lot of the agents. And then you got Zillow Showcase, which is some of those things. And then things like Zillow Home Loans, which is another business on top of that. That's the, can I afford this house, or how much house can I afford? So I think the platform play here is ultimately what's the most impressive. I'll just pull up some of their financial numbers as well, because I think we're in the early phase of operating leverage for Zillow, and we just still haven't seen yet that this is as profitable as the company is going to be. So I'll pop this back up again and see how I think about building this out. First of all, I guess I'll show the KPIs. So residential business is going to be traditional, the fees that they get for buying and selling homes. So this is coming from real estate agents. That number continues to grow a little bit faster than the market overall. So that's what you want to see. You don't want to see them just, increase their take rate at a really rapid rate, because then that's going to bring in a whole bunch of competition. It's going to cause those brokers to say, hey, wait a second, this looks like they're trying to disrupt our business. You want to boil the frog here. That's really the idea, is build out all these tools so eventually a normal person can just list their home themselves. But right now you want to keep those real estate agents in the flow. That's what they're doing here. Let's take that away, because this is where the real growth comes from. Residential revenue. This is what's just been absolutely phenomenal. They're guiding for, I think, another 30 or 40% growth in 2026 from the residential business. And again, the housing market can be strong or weak, but residential business is going to be, I think, pretty consistent. You're going to need, if you're renting an apartment, you're going to likely move apartments every few years. So that's something that's probably going to grow pretty consistently. And then mortgages, the same thing. They're not going to be a company that's going to keep mortgages on their balance sheet long term, but they are going to be able to take that little cut from them, just like a mortgage broker would. So, I think things are moving in the right direction. Now, let's look at some of the operating metrics because this is where we need to see some improvement over the next few years. So this is operating profit. So this is what you want to see is numbers moving up and to the right. So we're not quite at the point where they got a huge operating profit yet, but you could potentially see that turn around in the next year or so. Cash flow. This is going to take out. So I'm going to take these away because this goes back to the iBuying days. So let's just go through the December 2023. Okay, we'll hide operating profit. Cash flow is pretty solid, $235 million over the past year. Again, we're not quite seeing that operating leverage yet, but as residential grows, as mortgages grow, as the housing market and the sale business continues to improve, that should grow. And then the other thing that I keep an eye on is where is their stock-based compensation trending? This is, if you're going to have a critique of Zillow, the biggest critique could be $390 million worth of stock-based compensation is just crazy. That's diluting any improvement that you're going to have in the business long term. So this has got to come down, and it has come down 7% from a year ago. Looks like we're there. I think they're expecting that to come down again in 2026. So it looks like we're heading in the right direction from a stock-based compensation standpoint. Again, this is another one a little bit like Owlet. If this is an asymmetric stock, we're gonna look back on this as obvious, but it's not necessarily obvious today because both of these companies have not gotten to operating profit positive, but that could be coming in the next 12 months. And typically when you make that turn, if you start to see that operating leverage kick in, that's when the market's really going to start to notice. You're going to have an enterprise value of sales go from 3.5 to 10. Price to earnings and price to free cash flow, probably not things we should be super concerned about. But even on a forward basis, price to earnings is 17.5, price to free cash flow about the same, 17.6. So the idea here with Zillow is not that 2026 is going to be, here's what they're going to do versus their expectations. The idea is if this is the company that's doing everything for you in real estate 10, 20 years from now, this is not going to be a $10 billion company. This is going to be $500 billion company, but it's because it's going to be the platform that we're listing our houses on, that we're doing real estate transactions on. That's going to ultimately be the future of the company. So I just think we haven't even really scratched the surface of the potential for Zillow. Like I said, let me know if you have any questions. Put those in the comments section, and I will try to get to everything I can. If not, we'll just go through Garmin really quickly. Garmin has actually been one of the best performers in the asymmetric portfolio, crazily enough, in 2026, up 24% year to date. Well, here's one of the things that's kind of wild is the market has just gone, what companies are going to be here 5 or 10 years from now and are not going to be disrupted? So even Alphabet, phenomenal company, doing extremely well. It's the biggest holding that I have. That company, that stock has gone down because the market's going, what's the disruption potential? So let's just pull in some of the normal metrics that I look at. Revenue is in blue, revenue growth. So 15.1% revenue growth in 2025, not a massive grower, but you do get operating leverage, almost $1.9 billion worth of operating profit. And this is just going to be a company that's going to consistently grow, probably in the low double digits, both on a revenue side and an operating profit side. It's probably not going to be super exciting. It's not going to be Robinhood type growth or anything like that, but it's a reasonable multiple, 29 times earnings, 26 on a forward basis. And you get a 3-year and 5-year growth rate that are both in double digits. I think the upside potential to me is not only selling more hardware, but their subscriptions. I have actually advocated, so they have this Garmin Connect subscription, which will help you, eat a little bit better. They have some workout plans. There's just some kind of digital tools there for improving your health. I think they can make that much bigger by buying a company like Peloton. So I'll just show you what this would kind of cost them, because I think this is just cheap optionality for them. So enterprise value today is about $2.5 billion. That's even after it had a little bit of a pop recently, but $2.5 billion, you can maybe get it for $3-4 billion. That's less than 10% of their market cap. You bring in a couple of million subscribers, increase the value of that subscription, and now you can integrate all those devices. I think the future for Garmin is going to be being the company that is integrated. That's kind of the data source. Is the human data feed. They even have products for animals. They have a horse's thing you tie around a horse's tail. Just crazy if you kind of look at their breadth of product, but their data feed is, I think, going to be really important as you look at something like healthcare. As we're doing labs, you want continuous data about how is Travis sleeping at night? What is his heart rate doing? Is he working out the way that he should? They have a smart scale that will tie into that as well. All that information is going to be really important as we start thinking about peptides and we start thinking about all kinds of other medical interventions or improvements that we can make. So that's the thesis there. That's been the one really solid performer for the portfolio. But hopefully that's helpful in understanding kind of what I was thinking for the month of April. Like I said, before we get out of here, if you have any questions, let me know. Otherwise, I will definitely be back probably later in the month. For subscribers, particularly in the newsletter, you probably notice this a little bit more. I will be out most of the next week doing our late spring break. So it's 3 weeks that I take off with the family, spring break late in August, and then Christmas. So we got a late spring break for us this year. So I'll be taking off at least part of the week. There'll probably be Sunday emails coming out, and I'll let everybody know on Thursday what that looks like. But if you're watching this from there, just expect to see that maybe a little bit more chaotic on a posting schedule through at least the 17th. So thanks everybody for watching. Thanks everybody for being a subscriber. Really appreciate it. You all make this possible, and we will see you next time.